Hi, this is Hutch with BankingTruths.com, and today we're going to discuss whole life for college and beyond. Because let's face it, most people think of college savings plans as a single-use asset, one and done, but it doesn't have to be that way as long as you don't kill the golden goose with college. Whole life gives you the opportunity to fatten her back up, and by doing so, she'll continue to lay those golden eggs throughout the life cycle of your child. And that's what we're going to look at in an example in this video. And it has to do with something that Nelson Nash called being an honest banker, not just raiding the kitty and cheating yourself out of all future spoils. By paying back even minimal amounts, whole life enjoys constant compounding, even on loan money, and it does so without market risk or taxation, which is unique to this vehicle. And also there's the potential for positive arbitrage through either policy loans, but also through synthetic non-direct recognition, these outside loans that have really low interest rates, especially now during COVID. So in this example, we're going to look at a case study of a child borrowing for college at age 19 plus, and then paying back minimal amounts so they can use their bank as a down payment for a house at age 35. And again, making some just minimal service payments, and by doing so, they can also borrow for retirement dynamically from age 66 plus. Not just steady stipends of retirement, but taking massive policy loans during periods of extended market losses or regimes with really bad tax policy, which is something to be feared. So let's go ahead and take a look at the data. Bear with me with all these columns and numbers. This policy is actually going to tell a story of our young student through the different phases of her life. And we're going to compare the exact same inflows and outflows and plugging them into our banking calculator to simulate traditional investing and savings to test the efficiency of this policy. So what we have here, if her parents are going to pay premiums for the first 7 years, $15,000 a year from years 1 through 7. They are, however, going to take loans from years 2 through 7 of $11,500. So the net contribution is actually pretty small after the first year. Now, after that, our student is age 25. And to instill a responsible savings habit, their parents are going to insist that she pay $3,600 a year or $300 a month from her own money. Now, $2,896 of that is going to go towards just the base premium, and the other $704 is going to be paying some loan interest. Now, you can see that the loan balance is actually bigger than the net cash value. Now, the total cash value is actually those two numbers combined. That's what she has inside the policy, earning guaranteed interest and dividends. But how much she has available is just the net cash value. But as she continues to pay the $3,600 a year, she builds up a nice little balance to the point where she's 35. She has enough equity to take a $78,000 loan towards a down payment on a house and still have $15,000 of equity inside the policy. Now, if we jump to the next phase of her life from age 43 to 58, we can see that she's paying a little bit more ever since she took that loan. Instead of paying $3,600 a year, she's going to pay $6,000 a year, and $2,896 of that is still going to the base policy, and $3,104 is going towards paying some of the loan interest. The loan balance keeps accruing against her, and keep in mind, this is a policy loan. It's not as efficient as what we call synthetic non-direct recognition, which we're going to show you later on. So this is actually a pretty big loan balance ballooning against her. In spite of that, she's building pretty nice equity inside the total cash value with just that $6,000 a year. And in this scenario, we don't show her taking any loans from age 43 to 58, but as we look back at that total net cash value column, what you can see is she's building a nice war chest to take advantage of strategic real estate opportunities, or invest in her own business, or invest in the stock market when it's down, or whatever that looks like for her. She also doesn't need quite as big of an emergency fund as she would need if she didn't have this policy. It's also worth noting that her total death benefit is quite high, considering that she started with just over $1 million. And even though part of that is her cash value or her equity in the policy, she has quite a bit more than her equity in the policy at all given times, alleviating the need for some term insurance that we're going to model in the other scenario. Now, things get really interesting from ages 58 to 77 as she transitions from her working years to retirement. Now, at age 66, we can see she stops paying premium. And that little footnote over there, that indicates we're doing a reduced paid up. That's why the death benefit drops from 1.9 to 1.1. And by doing so, what it does is it turns the whole policy into a big fat PUA. So you can see the loan balance gets wiped out to zero and the cash value didn't drop at all. In fact, it grows quite nicely because it's most efficient. It's shed of mortality charges, it's shed of loan interest, and we're going to say at age 66 that she took her retirement from other sources, maybe from her retirement plan because the market was doing nice, it was a good tax regime in Congress. But let's say from age 67 to 69, there were some bumps in the road. The markets went down, so she would have to cash out more shares of her mutual funds to make the same retirement income, or a different regime came into Congress taxing her retirement plan or investment income much more stringently. And remember, she was only putting in $3,600 and $6,000 a year into this thing, so she could and should have been investing in other things. So from this age 67 to 69, she's going to take some massive loans of $120,000 a year. And you can see the policy equity drops from $547 all the way down to $239. Now, there's a year off there at age 70, and what we're simulating is that markets have come back a little bit, but we want to see if they come back a little further. And so we can take our retirement income from there, but we're not going to pay down any of these loans yet. That's what happens from 71 to 73. You can see $60,000 a year. We took 120, but $60,000 a year goes towards fattening up that golden goose. Again, we can see the policy equity growing from 239 back up to 489. In that age 74, maybe the market's flat, so we don't want to pull. Maybe it's down a little bit, but we don't necessarily need as much income, so we're just taking a year off. And then again, something bad happens either with taxes or market losses, and so it's 75 and 76. She takes two more $120,000 loans, and it puts stress on the policy, and she could and should pay some back, but she's got over $300,000 of cash value available. This is the proper use of a policy in retirement. In fact, let's switch now to our banking calculator, see if we put the same funds in there, what kind of rate of return this would equal, or what would make it a good or a bad policy. Now remember, as we look at the banking calculator, this is no longer the policy data. What we're doing is we're simulating saving and checking and savings or a blend of investments. In fact, we applied a 6.33 blended rate of return to all of the same inflows and outflows with only a 25% tax rate that never goes up, which we think is very generous. So if we look, it's the exact same, $15,000 going in for 7 years, $11,500 coming out years 2 through 7. In this case, it's a withdrawal since you're just taking out from accounts you put in. After that, putting in $2,896 plus $704, that equals the $3,600. If we scroll down, we can see the $78,000 coming out as a withdrawal to make a down payment on the house. After that, we see $2,896 plus $3,104 going in. That's the $6,000 total after we make the down payment. We also see this $882. That's an outflow. That is actually term insurance. So we did a 30-year term policy for the lowest amount the policy ever was. As we scroll down to retirement, what we see here is payments stop at the end of age 65. Just like in the policy, take a year off, then $120,000 comes out 3 times in a row, then a space, then putting $60,000 in 3 times in a row, then a space, then $120,000 coming out a couple times in a row. And what we're left with the parameters that we already discussed, is $315,000, which is pretty good. When we look at the policy, we were actually left with $316,000. So an additional $1,000 than the 6.33% account at a 25% tax. What happens, do you think, if taxes go up? What happens, do you think, if the child isn't that great of an investor? Well, and not only that, but remember, there's a death benefit not only the whole time greater than what we showed with the term insurance, but there's a $809,000 of death benefit. They're age 77 at this point. So if they were to pass away at this point, there's way more than what's happening in the stocks. Now, remember how we said we were going to model some of the outside loans, the synthetic non-direct recognition? You can get these loans. They're usually based on prime minus some kind of factor depending on how big your cash value balance is. But there's a floor, and the floor is 3.24%, sometimes as high as 3.5%. We're going to use that 3.5% floor for the entire time. And by doing so, what we do if we model that outside loan instead of using the policy loan, instead of $316,000 of cash value versus the $315,000, how about $2.2 million of cash value? Now, I know it seems crazy, but we actually did model it. But because there's positive arbitrage happening for this long of a time on a steady basis, you end up with so much more cash value. And if we see what we need to earn it as far as a blended rate, like not only in the stock market, because chances are your kids aren't going to be totally invested in stocks all the time. They're going to keep some money in cash. Well, if we just use a blended 9.66% rate of return and taxes don't even go up, the alternate loan scenario is still beating the 9.66% account. And if taxes go up, it's going to just kill it, right? So you can see it's like beating it by almost $900,000. Again, 9.66, there's a lot of speculation involved in that. Now, granted, over the long term, stocks have done really well, but imagine all the times that we showed where there was a nice war chest and your kids want to invest in real estate when it's down, or invest in their business while it's down, or save their business while it's down. The stocks are going to be at their lowest point versus the policy is going to be cooking along at a steady clip. What's interesting is if I do model the kids not getting as good of an investment rate, so if I put 4.75, you can see they're left with a paltry $4,200 at age 77 after taking those final retirement withdrawals, versus in the policy using the inefficient policy loan, there's 316 of cash value, 809 of death benefit, or in the alt scenario, 2.2 million of cash value, 3.8 million of death benefit. I mean, it's just staggering. And let's just say they even got like 3.5. Well, what you can see is they actually run out of money after that third withdrawal. So they're tapped out. They retired at age 66. By 69, after the first bump in the road in the market, they're toast. They're done. So I know some of you were saying, hey, Hutch, yes, the kids may not be as good of investors, but isn't it also true that whole life dividends could go down? Yes, it's absolutely true. Even though we're at or near historic lows, they could continue to go lower. And so what I'm showing here on the alt loan scenario is the whole life dividend being a full percentage less than it is now, because usually they just lower it in increments, but let's just say it's a full percentage less, but the alt loan is still at a floor that's higher than it is today, that 3.5. Now, most likely these banks would go ahead and lower their floor to attract borrowers, which essentially you're just paying them free money by these loans backed by the highest quality paper in America. But what's happening is when we look at the arbitrage of even the lower dividend and this 3.5% loan, which probably would go down, the numbers are still staggering. Versus the 6.33, we're still looking at 827 of cash value. That's more than double, way more than double. And 1.7 million of death benefit. That's like 5x, over 5x at 6.33. So what does it take? If we change the rate of return to 7.75 and we're not even raising taxes, you can see the cash and investing account wins by just over $1,000, $829 and change versus almost $828. There's still 1.7 million in death benefit. That's more than double. That's at 7.75 with the dividend a whole percent lower and not even lowering the outside loan rate where it is today. It's actually higher than where it is today. Again, if we raise taxes to just 33, well, now all of a sudden it's crushing again. So what's the bottom line here? If you're looking for more safety, more stability, more certainty when putting away money for your kid's future, don't use a single-use asset like a college savings program that's going to end as soon as they're done with college. Consider whole life. You don't need these astronomical rates of return to make it perform well. And that's because the entire balance continues to earn this guaranteed interest and non-guaranteed dividends, even while the money's out on loan using it for other things throughout their life. And the positive arbitrage effect can be substantial when they get to retirement. And if you haven't seen it, definitely check out our other video on kid policies, juvenile policies at bankingtruths.com/kids. And when you're ready to model your own numbers, definitely use our schedule link below to book a time on our calendar, and we could start to model these numbers for your particular situation.